Good morning. Welcome to Trading Hour. And what a good morning this has been. The Sensex scales 80,000 mark for the first time ever. And the good news is the morning has been largely steady.
Yeah.
Right now on the ticker, it's not that the Sensex is showing a number above 80,000, but we're more or less there. It's not that there has been a very sharp profit booking after scaling that milestones, and it's all courtesy banks. You pull up the contribution plate and you will see it's HDFC Bank right on top providing that support. ICICI Bank, Axis Bank, that's where those gains are. And you know, year to date, HDFC Bank has been such a laggard. Year to date, HDFC Bank is only up 5%, and all those gains have come in this week itself, while an ICICI Bank is up 20%, and Axis Bank has gained close to about 16%. Remember, today is also the Nifty Bank weekly expiry. And on a side note, the telecom tariff. So Airtel and Jio is effective today. For Vodafone Idea, it's tomorrow.
Well, it's banks all the way, Rima, absolutely. And this is a market that's really moving on steroids. The momentum is real. Like you're saying, it wasn't touch the milestone and then a big profit taking come through. It's been a very steady morning. So we're digesting these gains rather well. Yesterday was a day of pause, and today the bulls are back at it. And HDFC Bank has provided that much needed ammunition for the entire banking pack. In fact, pull up, some of the top movers. You'll see HDFC Bank is right up there, but Kotak, ICICI Bank, the entire list, even SBI for that matter, all frontline banks are running. So that's the first good piece of the story. The second story is that some of the consumer stocks and some of the auto stocks, they're also powering through. So it's not a very narrow banks only or HDFC Bank only kind of a move. Look at some of the top winners on the Nifty. You'll see Britannia there. You will see names like Tata Consumer over there. In the auto pack, you're going to see names like Eicher Motors come back. M&M is revving up again. There's buying on a Bajaj Auto. So stocks that have already been strong. Basically, buyers are going back to where the strength has been. That's sort of really showing up, at least in the auto space today. Pull up the Nifty contribution chart, so that will kind of complete the picture. It is an overwhelmingly green day. There's no denying that. It's actually only some of the big IT boys. They're cooling off after yesterday's run. So your TCS, Infosys, those are the names on the downside. Small tweaks there. Not like a big slide or anything. And Reliance is the other one that is, a drag on the lower side. But, not really a drag because the Nifty is cruising along. The intraday high for the Nifty, by the way, has been above the 24,300 mark. So milestone after milestone, almost on a daily basis. And we're not too far away from that intraday high. That's a large cap space. Very quickly to round up mid caps as well. Mid-cap index is not bad. It's about a 0.5% increase for the mid-caps. And if you go down to individual stock-level names, then lots of high flyers, and we'll get to some of them as we go along. The advanced decline ratio, very strong at well over 1,600 stocks on the advancing side of the screen. So it's a green screen. It's a green market. Plus, Rima, there's a lot of primary market action as well today, right?
Two IPOs opening up for subscription. One of them is MCure. We chatted with the management just about 10 minutes back. And the other one is Bansal Wires. And Bansal Wire management is going to be joining us on Trading Hour. It's a smaller company. They're looking to raise 750 crore. But MCure, of course, is the larger one. 19,000 crore will be the post-issue market capitalization. While for Bansal Wires, which is a manufacturer of stainless steel wires, their market cap will be about 4,000 crore rupees. But back to the big story, and the big story undoubtedly has been HDFC Bank as the stock continues to hold on with a big gain, surging after the latest shareholding pattern has shown a drop in the FII ownership, which basically means there is headroom for further inflows by MSCI. MSCI is likely to increase their weight in HDFC Bank when in the month of August. Earlier today, we had a chat with Sriram of IIFL Securities, and he's talking about a massive inflow of $3 to $4 billion. Listen in.
So HDFC Bank wait up event has been one of the closely followed events in the Indian markets. So we were expecting this to happen. The foreign room has opened about 25%, and as a result of this, the adjustment factor will be revised from half to 1. This should lead to passive inflows of roughly $2.8 to $3 billion. We anticipate a further up move of 4 to 6% in the name in the run-up to the deval event. In terms of impact, Prashant, it would be the likes of Reliance, TCS, Infosys, and all, which have a higher weight in the index. But in terms of ADV, it should not have that much of an impact because all these are very, very liquid names.
Okay, so the much anticipated FPI headroom has opened up for HDFC Bank. And the anticipation is that because of this, MSCI will finally increase the weight of the stock on its indices. And that figure that you heard there, $2.8 to $3 billion, that's only passive flows, in funds which are just following the MSCI indices as a benchmark. And then there's the active fund management part of it. So maybe more money comes in. And that's really caused a big flutter on the stock and the banking pack today. Well, let's discuss the market and this development further ahead with Aditya Sood, fund manager at Incred Asset Management. Aditya, great to have you with us on the show. It's a good green morning and the market's gotten kind of used to it. Let's actually discuss this big news on HDFC Bank and what it really means, because I think for the longest time, the market has been waiting for that big bull run to start playing up on blue chip bank stocks as well. How do you view today's announcements with respect to HDFC, and what is your stance on frontline banks?
Yeah, so we have been, slightly turning positive on frontline banks, after being underweight for like close to 6 months. And the reasons are very, very simple. I think so. If you look at banking as a space after 6 months of underperformance, possibly it is one of the most reasonably priced, space. If I look at sectors. Secondly, there is considerable room, for price to book multiples to expand over a period of time, because essentially, if you look at retail banks, and that is true of HDFC and Kotak, last 5 years practically returns have been 4 to 5 years returns have been zero. So our view is that, as they gain market share, as the credit growth accelerates, obviously there is some bit of room in terms of, expansion. And what we are seeing in, for example, Federal Bank, reported the numbers today. What we are seeing is that, the loan growth continues to be very, very strong. So the price to book multiple expansion coupled with loan growth, and obviously, asset quality continues to be, decent for a lot of these large cap banks.
Federal Bank is the other big mover on the back of its Q1 update. The stock has hit a record high. But Aditya, particularly on HDFC Bank, now this was a trigger which has played out. The next one will be the earnings, when they report their Q1 FY25 earnings. And I remember last quarter was a bit of a disappointment. So particularly on HDFC Bank, what is Incred expecting? Do you think earnings can provide that next trigger, which will drive the next leg of an upside for HDFC Bank?
I think so. More than earnings, people are really concerned about deposit growth at this point in time, because, there seems to be a deposit wars, a sort of a situation which is going on, particularly on the banking side. As far as earnings are concerned, there was an element of, one-off with the management also highlighted, and that came essentially because of the merger from the asset quality side. I think so. Earnings are going to be key. But what we see, it is more about under ownership and, one round of sell-off, because, essentially a lot of people thought that, the stock has underperformed massively. And obviously, it is a very large weight in the, MSCI index itself. So what we do believe is that, it is more of, under ownership and market clearly looking at incremental deployment or in terms of, under ownership. And secondly, also, people are focusing on areas wherein, there is considerable margin of safety. And obviously, there is an element of, where can you put, large sum of money to work as an asset manager. And that is the reason why we are seeing, some bit of catch up in terms of, stocks wherein, essentially, if you look at, IT, for example, what we are essentially seeing at this point in time is that after 5 quarters of discretionary spending not picking up, what people are expecting is that, this is a good space to be in. And this is where consumer was, 6 months back. So I think so it is more driven with, under ownership and, putting a large sum of money to work.
Absolutely. Got your point. So it's more of a tactical play, perhaps on HDFC Bank, Aditya. We want to ask you also just purely on fundamentals and earnings, which are the bank stocks that you like. But before that, allow us to go to our colleague Abhishek, because a lot of these updates you were mentioning, Federal, a lot of these Q1 updates have started pouring through for banks. Abhishek is running us through the details. Abhishek, fill us in.
Well, to begin with, Federal Bank quarter-on-quarter, the loan growth is pretty healthy and one of the best in last 7 quarters. CASA ratio is at, the 36-quarter low or 9-year low, but no taking away from the fact that it's remained vulnerable on account of healthy growth in other kind of deposits that you have seen. So, deposit is up 19.6% YOY and 5.4% quarter-on-quarter. CASA growth is at 5% quarter-on-quarter in absolute value. It's a healthy growth rate, but due to the fact that other deposits have grown faster, this ratio has dipped a bit. So, CASA ratio has come in at 29.3% versus 29.4% in the previous quarter. Customer deposits that have grown robustly at 19.8% YOY and 5% sequentially. Healthy loan growth as well, more than 20% YOY and about 5.5% sequentially. So, you have, a credit deposit ratio which has improved both YOY and quarter-on-quarter for Federal Bank as well. Back to you.
Okay, all right, Abhishek, got it. So that's Federal Bank. We had a couple of others, yes, etc. all play out as well. So just to complete the picture on banking and lenders, Aditya, so purely on fundamentals, we've discussed the tactical move on HDFC Bank. Purely on fundamentals, where would you put your money on banks? Whether it's large or mid-cap, I mean, you can pick any market capitalization.
So we like banks, wherein there is considerable optionality of, price to book multiple expansion. So if you look at, Federal as a case in point, ROE profile is, closer to 15%. There is obviously impending CEO change, which can act as a catalyst, from a near-term perspective. If you look at the price to book multiple, it is trading at 1.1 time, forward. If you look at, ROAs, and generally our framework on banking says that, possibly ROAs, there are very few banks which have ROAs northwards of 1.5%. Obviously the big banks in India have got ROAs northwards of 2%. So if we are considering a mid-cap sort of a bank in our portfolios, we would look at, scope for ROA improvement. And what we have seen is that, price to book multiples move more or less in line with, they have a very higher correlation of ROA improvement. So we are looking at banks wherein there is significant scope of ROA improvement, and that includes, Federal, that includes CSB, which we own. Obviously, both these banks have got, considerable amount of gold loan as a part of their portfolio. So we like secured lenders at this point in the cycle. We also have an exposure towards NBFC, which is obviously, majority owned by Federal Bank, which is known as FedFina. So if you look at, FedFina, for example, they would have 85% of their book, which is in a combination of mortgage and gold loans. So mortgage and gold loans within banking space, if we are evaluating a, small mid-cap bank, becomes a very, very interesting combination at this point in time.
Okay, so you like CSB and you like FedFina, which is owned by Federal Bank. Aditya, what else? The last time we spoke to you, you said you're overweight on technology, auto and consumption. Has there been any shift in your portfolio and can you talk about it?
Sure. So on the technology side, we like product companies, particularly wherein there is got a lot of scope for expansion in terms of, headroom in terms of margin improvement. And we own, a company known as Intellect Design Arena. What we structurally believe is that, there could be optionality in terms of, margins moving from 21%, which is getting reported currently. Obviously, it is a combination of the GEM contract, which they have, sort of vacated very recently. That would lead to a scope of, working capital improvement for them. More importantly, for structurally speaking, I think so margins can move from 21% to more like 24 to 30% over a period of time. A 3-year view, what we are forming is that, margins can be as high as, 27 to 30%. One of the themes that we like is BharatNet. There is an impending order, I think so. This is going to be a more or less in line with a $10 billion order, which is going to come through. And we like Tejas Network here as a proxy play on BharatNet. I think so. The TAM is expanding very, very rapidly. And once BharatNet contracts, come through, and it is going to be also beneficial to the cabling companies, so we own Finolex Cable in this space. So this is a theme that we like a lot. I think so. TAM is expanding very, very rapidly. More importantly, the profitability that we are going to see in terms of improvement in profits, and these companies are, more or less reasonably priced. in our framework. So we like this complex. We like obviously the ARPU growth story on the telecom side, but we are playing it through companies like Tejas, which obviously are going to benefit. On the technology side, we like companies which are focusing on a combination of discretionary spending, because we expect post the US election, the discretionary spending to pick up. If you look at the large cap technology companies like Tech Mahindra, Infosys, or TCS, the dividend yield will support. So I think so valuations are very close to bottoming out here. And as and when the US spending, US elections are behind us, possibly this sector should do well. So we have an overweight stance on technology as well. On the consumer side, we like companies which are more exposed to rural as a focus area, wherein we have got Hero, we have got Stovecraft on the consumer durable side. And what we are witnessing now on the consumer durable side essentially is that there is demand revival, particularly on the rural side. So the clear-cut focus area, and this is now getting reflected, for example, in the SSG growth that VMart is also reporting, because essentially VMart has got more exposure to tier 3 and tier 4 as a play. So what we are seeing is that, same store growth is improving over a period of time on the rural side. So we like these plays which should benefit on account of a rebound in rural consumption.
Okay. All right. Good chat. As always, Aditya, thank you very much for joining in. Appreciate you being with us on the show this morning. Well, that's a view coming in from Incred. Well, with that, we do have to look at quite a few of the stocks that are, buzzing around in trade. We'll do that. But before that, a quick break as well. We'll, of course, take that break and come back on the other side, and we'll look at Bansal Wire. This is the, new IPO that has opened out. We'll touch base with the management, try and understand the business model. Arun Gupta and Pranav Bansal will be with us.
Welcome back. This is IPO KYC, and stainless steel wire manufacturing company Bansal Wire Industries 745 crore IPO opens today. They've set the price band at 243 to 256 crore rupees. It's an entirely fresh issue, no offer for sale. And we're now joined by Arun Gupta, Chairman, Whole-Time Director, and Mr. Pranav Bansal, the Managing Director and the CEO of the company. Gentlemen, thank you very much for joining in. Mr. Arun, if I may start the discussion with you, you're looking to raise about 745 crore rupees. Fresh issue, most of it will go in repaying your debt. What is the current debt? And after you utilize some of the money to pay the outstanding borrowings, what will the debt number stand at, and how will this bring down your interest cost?
We are coming with a 745 CR IPO, out of which around 560 will be repaid against the old debt, which will satisfy almost maximum debt what we have, and balance money we will use, because we are a growing company, we will use for a working capital from there on.
Okay. So Pranav, will you be debt free after this?
Not 100% debt free, but almost debt will be repaid.
Okay. Pranav, just a quick word on the company's financials. We were looking at your company and the listed peer, Rajratan Wires, the comparison with your peer, Rajratan Wires. While you're much larger in size, your revenue is about 2,400 crore plus, and Rajratan has revenues shy of 1,000 crore rupees. Your margins are much lower at 6%, while they have, low teens kind of margins. One, can you explain that? And two, what is the outlook on improving margins from here on, or is this a 6% kind of margin level for the company?
Let me give you first a brief on the kind of products that we make, to make you better understand, what we do and where we are. So today we are already the second largest steel wire company in India there is. In stainless steel, we are the largest stainless steel producers in the country. The journey started for us in 1938. So today I am the third generation of my family in this business. My father is the one who started manufacturing, hence Bansal Wire, the company, was started in 1985. And since then, we've been growing. We keep on adding new products, new verticals. So today we are in three main verticals. High carbon wires is one, stainless steel wire is second, and third is the low carbon wire. High carbon wire is a product that is used majorly in automotive, general engineering, infrastructure applications. Low carbon is a product that is used majorly for cables, fencing, and these kind of products. Stainless steel as a product, I would say, is used in all your consumer durables. So wherever wire is exposed to the environment, stainless steel plays the critical role. So you will see in all your modular kitchens these days, for example, everything is made out of stainless steel. Kitchen baskets, fittings, everything is stainless steel. So as far as product goes, we supply for the simplest product like a stainless steel scrubber, and a wire even is supplied to Boeing. So we are there across the whole spectrum. Now, when we talk about margins, we today have more than 3,000 products. And therefore, our margins for all 3,000 products are quite different. So now how we look at our margin is more from the return ratios. So we look at we try to focus on ROEs and ROC more than EBITDA margin, because the kind of diversity that we have, every product will have a different kind of a margin.
No, absolutely. Pranav, allow me to come in over here. Pranav, hi. Great to have you and Mr. Gupta. This is Surbhi here. Allow me to come in over there. And, since we're trying to understand the model, we'll come to ROCE and ROE separately. But just to understand, to go back to Rima's question, can you tell us between low carbon, high carbon and stainless steel wires, between these three broad categories, which is the most margin accretive for you? And again, just to understand why a peer would be operating at 14% margin, you're operating at 6%, just to understand whether there is any plan to maybe, as you're looking at your product mix, to maybe gear it more towards the higher margin products. Just a little more color on the EBITDA margin front, because we'll require that from a quarterly analysis point of view.
So, as I said, we are in three main verticals. High carbon for us is a product that gives us about 13, 14, 15% kind of an EBITDA. Low carbon is a product that gives us about 5-7% EBITDA. Similarly, stainless steel is a product that gives us 5% EBITDA. From here on as well, we are adding a fourth vertical from the Dadri facility, which is a facility that we've just started. It is, of course, India's largest, but also one of the largest wire facilities there is in Asia today. And in that, we are adding a fourth vertical, which we call specialty wire, which is more towards higher margins and higher growth areas, for example, automotive, and especially in the tire industry. And in that product, the main focus area for us is steel cord, in which we will be the first Indian company to manufacture it in India. And,
so that's really interesting. So Pranav, Pranav, so just to expand on that point, that's really interesting. So now you'll have a fourth big sort of segment coming up, and it's a large facility, you're saying probably one of the largest in Asia, and this is specialty wires. So let's say 2 years or maybe 3 years down the line, what's your aspiration to move from 6% margin? Do you think by the time your product mix evolves, are you looking to get into double digits? Just give us a directional sort of aspiration for the company.
So, ma'am, even for the last 10 years, if you look at our performance, we as a company, we've grown at about 18-20% every year, be it for 10, 5 or 4, whatever years you want to see. Similarly, in EBITDA, we've been increasing our EBITDA by about 21%, whereas our PAT has increased by about 30% every year for the last 10 years. And well, honestly, we are very happy with where we are, with the kind of margin profile that we have today, because we believe our return on our investments are quite okay. Going forward as well, because the kind of products that we make, we consider it to be a backbone of any industry in India today. Therefore, we are still relying, and we will heavily bank on these product mix that we have been making for the last 85 years. But with that being said, definitely specialty wire is a vertical that we are focusing on. And well, we are going all hands on specialty wire, especially steel cord, because this is a product that has tremendous potential for us. Today, the market size of India is 2.5 lakh tons. And 60-70% of the demand is being met by imports. So we have only started with a 20,000 ton pilot project in Dadri. And well, we will continue to grow from there.
20,000-ton project for specialty steel wires. What's the revenue potential and when will it accrue to you?
The specialty wire project, the production will start within this financial year. If you look at the market prices today, it's about 140, 150 rupees a kg. So, looking at the current prices, it would give us about 300 crore if we make the full capacity.
So at 100% capacity, specialty wires revenue potential is 300 crore rupees. And it'll start sometime this year. What about exports? You also have about 11% of your revenues from exports. How are the margins there? Is that a growing market for you? And how much will it contribute, say 2 years, 3 years down the line?
So, ma'am, export has actually been a good business for us. In fact, this is a segment that we've recently started. We've only started focusing on export since 2016-18, something like that. And today, we've touched almost 11, even 14% of our sales in export. And the interesting thing, or the main accomplishment for us in export has been that 75% of our export comes from only Europe and US. So we believe being in such an industry which supplies, we today supply wires for almost all kinds of industry, whether it is auto, power and transmission, consumer durables, agriculture. So there is a demand of our product everywhere in the world. As long as any country in the world is growing, for us, our demand is growing. And from our performance for the last 5-7 years in export, we see something good happening in the future as well. But with that being said, our focus has always been domestic, has always been India. And with India now poised to grow at a higher rate than it has been in the last 5 years.
Sure. Just a quick last word. We've got 30 seconds, not even 30, 20 seconds left. Pranav, very quickly. So after repaying the debt, how much money will be put to work on the CapEx? Where is your current capacity utilization level? And by how much will capacity expand, say, by the end of this year and by the end of next year, FY26?
Very interesting question. In fact, we are today almost at full capacity. For the last 2 years, we've been at peak capacity utilization with 2.5 lakh tons of our total capacity being there. But now, and only this year, we've started production in the 5th facility of ours, which, as I said, is India's largest and one of the largest wire facilities there is in Asia. And that facility standalone has a capacity of 3.5 lakh tons. So basically, what I'm trying to tell you is that from 2.5, we are jumping to 6 lakh tons of capacity, which is already up and running now.
Mr. Gupta, Mr. Bansal, thank you very much for joining in and wish you all the very best. Look forward to more such conversations. Get into a break. On the other side, we'll put the spotlight on individual stocks which are in the news. Welcome back. Now, Persistent Systems is holding up in an otherwise dull market for IT. So, Persistent Systems is a gain of 1.5%. The company has made a small tuck-in acquisition. They've acquired Starfish Associates. The total spend is going to be $20.8 million for a company which has revenues of a little more than $8 million as of the last 12 months ending March of 2024. Small tuck-in acquisition. The impact on the revenues is going to be less than 1% and it's expected to get closed in the next 4 to 6 weeks. And the company that they've acquired provides enterprise communications software. The street seems to be pretty okay with the acquisition. The stock is up 1.2%. But another note, I was going through a lot of brokerages, right, to start preparing for the earnings season. And amongst the mid-caps, Persistent Systems is likely to report one of the strongest growth. The rough average is likely to be a 5% on a quarter-on-quarter basis. So there you have it. From June, one of the big... So while IT itself has done very well, right? But from mid-June, Persistent Systems has been a big beneficiary of the rally. The rally started at 3,200, 3,200, 3,300, and now it's at 4,500.
It's pre-positioning, I guess, people anticipating those big numbers.
5% roughly.
Which we haven't seen from most IT companies. 5% quarter-on-quarter growth is just, haven't seen that in a while. Absolutely. So let's quickly move on to the next stock that's on our radar. And this one is MOIL. MOIL has been surging almost 6-7% right from the morning after coming up with its quarterly update. We have Nigel with us in the studios. Nigel, they're surely pleasing the street. How do those numbers look?
Well, that's right. MOIL, if you look at it, if you just pull up a chart first of the stock, you'll see that it went to around 565, 570 odd. It went one way from around 380 all the way to around 565. And from there, it saw nearly around a 15% correction from the top. Now, post this operational performance, which according to Antiques estimates, it's more or less in line with what they're working with. But because the stock had corrected, the street seems to be liking it. On the sales side, well, it's up close to around 14.5%. Even the production number is up by close to around 7.8%. So the street likes both these two numbers. And keep in mind, they're also talking about expiration in meter terms on a quarter-to-quarter basis. That's this quarter, first quarter of FY25 in comparison to the first quarter of FY24. That's up by close to around 49%. That gives you visibility with regard to future production. Put everything together, pricing has been fairly good in the first quarter. Volumes as well up. Explains why the stock is surging in today's session. Back to you.
Thank you very much for that. And now let's go across to Mangalam for the business updates from V-Mart Retail. Mangalam.
Well, for V-Mart Retail, it's been a good quarter. If you look at the overall revenue of the company, it's grown at around 16%. The core of the company is V-Mart Retail, which has seen actually a revenue growth of 17%. Remember, all of last year, it was rather weak for the company. So on a low base, now we're seeing improvement. More importantly, improvement in the first quarter implies that maybe the second half of this year could be even better. And as a result of which, we are seeing a bit of an uptick on the stock itself. Is this led by same-store sales growth? Hell yes. We have almost 12% same-store sales growth coming in for V-Mart Retail and about 8% coming in for Unlimited as well. And they've added about 7 stores in this quarter, of which 5 have been directed towards V-Mart and the others have been Unlimited as well. And they've closed 3 stores as well. What's more important this time around for them is that, as sales increase for Unlimited, the margins will start looking like what they are for V-Mart Retail itself. And as they are closing some of the non-performing stores, that would lead to better operational efficiencies as well. So revenue growth with better operational efficiencies, with underlying improvement in consumer sentiment would be a trifecta that the street would be looking at for this year in particular.
All right, that is V-Mart Retail. Mangalam, thanks very much for that. The stock's been doing well. Let's move on and look at one large cap name from the pharmaceutical space. Now, here the news has not been that great. We're talking about Sun Pharma, and CNBC-TV18 has managed to access the warning letter that was issued by the US FDA to the company's Dadra facility. Remember, this came out a couple of days back, but now we have the details of this letter. Sudarshan will fill us in. Sudarshan, what does it say?
So Sun Pharma is in focus today on the back of an update to the warning letter that company's Dadra unit had received from US FDA on June 18. Now, US FDA had put the warning letter details on its website, but more than 2 observations that US FDA had made. The concerns are related to that US FDA is talking about the repeat violations that not company's only Dadra unit, but multiple sites that US FDA has observed repeat violations. US FDA says repeated failures indicate inadequate oversight and control over manufacturing of drugs, and it demonstrates that company does not operate an effective quality system. And on the back of these statements, US FDA has recommended Sun Pharma to engage a consultant to assist in meeting current good manufacturing practice requirements. And on the back of this, Sun Pharma's stock is currently near flatline.
Thank you very much for that. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar will join in on the other side.
Welcome back. The bulls are completely fired up. There's not been much change in terms of the way the indices are behaving. Yeah, you can say that from the highest point, there's been a minor cool off because the high was above 24,300. We've got Mitesh joining in now for some perspective and some more ideas. Mitesh, hi, good to be speaking with you today. So it's been it's an absolute blockbuster day thanks to banks and the bank Nifty. What suggestions now?
So I would say thanks to HDFC Bank.
Yeah, absolutely.
So I think one, it looks like, after a good move on the hourly chart, just a mild phase of consolidation doesn't look very bad to me. So we'll continue recommending and trading on the long side. Have a buy on granules with a stop at 499. Targets of 525 can be looked at. And ICICI Pru, I think, after a long time, that stock has come on the radar. That's a buy with a stop at 620 for targets of 660.
And on HDFC Bank, is there upside from here on, or do you think the rally's played out?
I think there will be more upside. See, there's some option writers concentration at the 1800 strike, but the stock has just made a fresh high. With the news, with the gap up, I think they should see continuation, even if there's a pullback for 1 or 2 days. So I would be buyer on declines over here, or if it starts getting past 1800, then look at a target of 1900 or thereabouts.
Okay. All right, Mitesh, thanks very much. We'll touch base with you again later in the afternoon for some more ideas. Thank you very much for those trades right now. Need to take a quick break. We'll come back with more on the markets in just a bit.
Welcome back. EPL, Epigra Limited, is a stock which has seen some buying for the second day in a row. This is a company which makes laminated tubes, caps, closures, dispensing systems and applicators, which is commonly used in a lot of consumer products like like a toothpaste, etc. They make those laminated tubes. Yesterday there was a Motilal Oswal note on EPL, and they pegged the target price to 250, and that's the reason why EPL has seen buying for the second day in a row. But ICICI Lombard, PFC, REC, these are all stocks where we've got some fresh brokerage calls coming through. Sudarshan joins in with the highlight. Sudarshan.
So after yesterday, Jefferies had upgraded ICICI Lombard. Today, CLSA has come out with its note on ICICI Lombard, and it has upgraded the stock to outperform from hold, and target is raised to rupees 2,000 per share. It says company's April-May motor insurance premium growth was at 31% versus industry's growth of 15%. It says worsening of peers' motor third-party loss ratio is leading them to curtail growth, and premiumization of cars and benefits from Motor Vehicle Act may aid the motor book. It has raised overall premium growth estimate by 2% for FY25 and believes momentum in motor book could persist further. The next is on PFC and REC. Bernstein has initiated coverage on both these stocks with buy call, and for REC target is rupees 653 per share, and for PFC target is rupees 620 per share. It says both these companies are amongst most preferred plays in power cycle, and investors are underestimating duration and intensity of this power cycle, and NPA risk for both PFC and REC is much lower in this cycle, and it believes that valuations are for both these companies are cheap despite the rally these companies have seen in the last 1 to 2 years.
All right, got it. Thank you very much, Sudarshan, for all the details. So those are some of the stocks buzzing on the back of those brokerage notes. We'll take a break, come back on the other side, and crude oil prices, they have surged past the $86 a barrel mark on Brent. We'll bring in Manisha with the latest on the oil market. All right, welcome back. As promised, let's now talk commodities. Oil is indeed on the boil. Let's get the price up on the screen because Brent, forget 83, 84, 85. Now we're talking over 86, almost $87 a barrel. It's been a massive surge in oil prices. We've got Manisha joining in to fill us in on the latest. Oil indeed on the boil, Manisha.
Well, I'm looking at the crude oil prices, which are trading at a 9-week highs right now, and we've seen constant gains into this one. For the month of June, we saw the crude oil prices gain up by 6 to 7%. For the quarter as well, it has been up by 13 to 14%, and the month of July has started on a positive note as well. So we're almost nudging that $87 a barrel mark for the Brent prices right now, and the support comes in because of the U.S. inventories. The latest API data shows that U.S. inventories have declined by more than 9 million barrels in the previous week, week, and there's an anticipated decline in gasoline and distillate stocks as well. The reason for this is that it is the US summer driving season demand, and the anticipation is that you will see travel increase by more than 5%, and the car travel will increase by 4.8%, and that will dip into the US inventories there. So that is the first reason. The second is also about the decline in US dollar that has led to many of these dollar denominated commodities trading on the higher side. The third is the Hurricane Beryl. Now this is the Hurricane Atlantic season which has begun, and Beryl has had a landfall in Grenada Islands there, but it is expected to enter into, even as a weaker version, into Gulf of Mexico by the end of this week. So this is something that is adding premium to prices. And remember, this is just the beginning of the hurricane season, so whether there is something that most of the oil watchers will keenly watch out for. It is also about the markets looking at the OPEC June output, which was slightly higher because of increased output from Iran and Nigeria, but the expectation that OPEC would want to push in for a higher understanding and sense of agreement is yet another reason that you have seen support from most of the world. Wall Street banks and brokerages also seem to believe that this quarter you could be looking at increase in demand, increase in deficit in sense of supplies, and higher prices also. A larger range that you're getting to see for this quarter for the crude prices is anywhere between 78 on the lower side to 98 on the higher side.
Thank you very much for that. That's an important update on crude. Tata Consumer continues to see buying. It's an upward chart through the day. 3% rally on Tata Consumer. It's crossed its 100-day moving average. It's still not at its 52-week high. The 52-week high on Tata Consumer was 1,269. So the stock is still about 10% away from its 52-week high, which it hit in the month of March. But there is that buying which has come through since morning on Tata Consumer. We'll wrap up on Trading Hour, but as we do that, we leave you with some important market opinion that we got earlier today from Prateek Gupta of Kotak Institutional Equities.
The general assumption is that the government will continue with its infrastructure thrust, its capex, the government capex that's going on, and there will be an increase in the outlays over there, but not like what we've seen in the last few years, which was at the expense of boosting consumption. It's more like a muted expectations from the budget that this will be more of the same, no major dramatic change. So therefore, if in the budget we do indeed get some dramatic announcements, some really visionary statements, although then obviously there'll be question marks on the execution, implementation, etc. But as of now, it's not seen as a very big game-changing event for the earnings outlook in the next 1 or 2 years. As far as consumption is concerned, that's definitely suffering, especially the low end of the economy is still not fully recovered. It's only gradually getting back on track. The high end continues to do well, but it's really the mass segment which is suffering, and the middle class, as you said. So there will likely be some kind of relief for the middle classes and the lower income classes, perhaps in the form of tax cuts, or it could be some direct benefits to them, or other kind of SOPs. But definitely some steps to boost consumption are quite likely. The question is, will it be big enough to move the needle? We think there'll be some steps, but not dramatic. I think the government will stay focused on the fiscal deficit.